That's here. We are really delighted to share with you the results for our second quarter. You've hopefully seen the press release and the fact sheet. But just to give you a few points as we kick it off, we had a really strong, robust quarter in Q2 with good performance all around in all of our parameters. First, we had double-digit growth now for the fourth consecutive quarter, 11.4% constant currency growth overall, and 38% constant currency growth in our digital portfolio. We also had a very strong operating performance. Our operating margin was at 21.7%, 1.2 points expansion from Q1. Many of the operating parameters and discipline are kicking in, and this is what's being seen in the operating margin performance. Very good, strong, large deals performance, 2.8 billion in large deals, and we've shared that data in the press release and fact sheet. Very good movement on attrition. It's reduced by 2 percentage points. And in fact, in the way we look at attrition, as we measure it on our tech services business on a voluntary basis, that's already starting to be below 18%. So overall, we are really delighted with the results we've had in Q2. We're also extremely proud in that we were awarded by Forbes the ranking number 3 for the best regarded company globally. And it's something all of us at Infosys are extremely proud of, a testimony to all the hard work of our people and the support of our clients. With that, I'll pause and open it up for questions with Praveen and Nilanjan here with me.
Thank you, Salil. Before we start the Q&A session, I would request you to ask one question per publication. The first question is from Bloomberg Quint.
Hi, Salil. I'm sure investors will be relieved to know that you maintained your upper end of the guidance, especially when one of your peers has indicated that they are unlikely to see double-digit growth. That said, I want to get a better understanding of how you're reading things currently, because there is still an indication that large financial institutions in the UK, Europe, as well as US are under a bit of pressure. And there is understanding that there's a slowdown in demand, and that could lead to delay in deal closures. That's as far as the financial sector is concerned. There's a lot of volatility in retail, which persists. And communications, again, there is still delay in allocation of the 5G spectrum. I believe that a lot of that is pegged on that. I want to know that even when you do see a relatively steady financial year, FY20, if you could tell us a little more about how you're reading into things when it comes to, things on ground. Praveen, a question for you on the deal signings. If you could actually tell us a little more about the size, the duration of the deals, also in what verticals are a majority of these deals coming as far as this quarter is concerned. And Nilanjan, for you, if you could actually quantify some of the factors that have come and played in favor of margins and played against.
Let me start with a color on the business and how we see what's going on in the market. First, 6 of our 7 large segments are all showing double-digit growth for Q2. We see a good traction, for example, if you look at energy utilities business, an extremely strong environment in that business. If you look at what we're doing in a high-tech telco business, again, an extremely strong environment in that business. To now come to financial services, we had a good growth in financial services in Q2. We see good demand. As we had pointed out last quarter, there is certainly some weakness that we saw in capital markets. And in general, there is something where the financial institutions overall are looking at spend differently. But for now, we see a good demand in Q2, a good outcome in Q2, and we will see how that plays out for the rest of the year. In terms of telco, we see a very strong demand, so I have no view that it's any different from what we had shared with you last time. We shared some weakness, which was very specific to manufacturing last quarter for the European segment. We see Europe as a geography a little bit softer, but overall manufacturing is in a robust place for us today. There's the view from a macro perspective is that the European market is somewhat slower. We see some impact of Brexit, but nonetheless, we maintain our guidance, which in fact, we increase the lower end of our guidance. So from 8.5 to 10, we increase to 9 to 10. So we remain quite confident in how this year will play out.
On the large deal front, we won 13 large deals, 2.8 billion TCV, highest ever. And for the half, when you compare on a year-on-year basis for the first half, our large deal wins TCV has been 75% higher than what we did same period in the first half of last year. This has been broad-based. 4 of the wins have been in financial services, 4 in retail, CPG and logistics, 2 in communication, and 3 in other verticals. Then geography-wise as well, we have seen about 6 in Americas, 5 in Europe, and 2 in rest of the world.
Yeah, so coming to the margin question, I think as we started the year on a low trough of 20.5%, I think we were quite clear that our guidance of 21 to 23 would come from the various cost optimization programs we had. The industry faces the usual cost pressures every year, which is, of course, discounts from clients, which, of course, come and hit straight away on the top line, and, of course, the compensation hikes. But we've got our execution machinery very, very right in this quarter. We've got the utilization up, so that's the first thing which flows to the bottom line. We've got our on-site mix coming down, so we're getting more work offshore to India. We are working on other programs around automation. That's a continuous engine we have. We continuously take out 2,500 to 3,000 people from our fixed price projects and plow that back and give that part of that money back to the clients. We're working on other issues like digital pricing. I think this is a new area we are looking at, is how do we price digital services and command a premium from our clients. So we have a very strong cost optimization, nearly 18 tracks which we have. It's run by a senior resource in the company. And from a quarter-on-quarter basis, we've gained about 110 bips of our margin improvement has come from operational parameters and cost optimization, which we're working on.
Next question is from CNBC.
Hi, this is Mugdha. Firstly, great numbers, so to start off with that. But the street was estimating that you would also up your upper end of the guidance as well by about 50 basis points. Any reasons that you've held back on that? Are you a little concerned about the second half of the year? And Salil, that's for you. To Nilanjan, I just wanted to ask you about the margins. The margins have improved, but where do you see margins for the whole year ending at in the whole band? And Praveen, if you can just tell us about retail. Retail looks a little weak. What is the outlook there? And of course, attrition has come down. So if you can just throw some lights on that. And Salil, one more question to you. If you can break down the organic BFSI growth apart from Stata for us.
So on the guidance, the good news is we've increased the lower end of our guidance. So instead of 8.5 to 10, we are 9 to 10. We had from the start of the year a view about the year, and every quarter we have strengthened the view that we have for the year. So there's no change in that. We know that seasonally the second half is normally weaker in our sector, and that's the normal sort of seasonality of the business. But overall, our deal pipeline remains strong. Our Q2 numbers are very strong, with 6 of our 7 sectors really recording double-digit growth. So we remain quite confident that our clients are looking at what we are providing to them in terms of digital transformation capabilities. The only caveats we mentioned were the ones I shared before, specifically with respect to the European market or capital markets, or at least in last quarter, some elements of manufacturing. On the financial services and others, Praveen will address that with the retail question itself.
On the retail front, obviously there is one sector which is closely linked with the consumer sentiment. With all the overhang of macro, talk about macro trade wars, and to some extent some reduced consumption that people are seeing in some of the global markets, obviously the spend in retail has come down. We had a fantastic year last year in retail, but in the last quarter and this quarter, we have started seeing some softness and slowdown. So this volatility will probably continue for some time till the macro situation improves. Because as I said earlier, this is a vertical which is probably very closely tied with the macro sentiment and so on. On the financial services, as Salil said, we have had a decent run so far. We have had last 2-3 quarters of double-digit year-on-year growth. But we do continue to see some weakness in some of the European banks and capital markets. And we also have to watch out for the seasonally slowdown in the second half. But we have a diversified portfolio. We have done well based on the past deal. So we remain optimistic, but we just have to watch out for the seasonality in the financial services. On the attrition, attrition has come down. The voluntary attrition is under 18%. It's come down. And we have, over the last couple of quarters, we have focused a lot on coming up with a new employee value proposition, several interventions. So we are really focusing on enabling employees, engaging them better, and rewarding them. So there are multiple interventions towards this. And slowly we have started seeing results. And this is something we need to continue to work on. No, normally, I mean, we don't really give that breakup.
So on the margin question, like I explained, we had 21 to 23. At first half, we have now at 21.1. So we have entered the guidance band. I think this is a good platform for us to build as the year progresses and to see progressive growth on margins from here. So we remain committed to the 21, 23.
Next question is from Bloomberg.
Hi, Praveen, Salil, and Nilanjan. So I want to ask you about the US market where you get almost 2/3 of your revenues from. What is the macro looking like? First question. Second question, I really do want you to give as much more detail about BFSI deals as you can. That accounts for almost 1/3 of your revenue. So these are two real key components of Infosys, and I would love for you guys to tell me more.
So the US market, I think the overall situation in the US market, the GDP growth is still quite good. If you saw the numbers for last quarter, there's obviously an ongoing impact with whatever is going on with the macro in terms of trade discussions and potentially some impact that might have on manufacturing clients. On the other hand, we see a lot of positive discussions, whether it's with telco clients, high-tech clients, utility clients, energy services clients. So overall for us, we remain optimistic. If you look at our growth year on year for the US, North American market, in Q2, it's again well over double digits, and we remain quite bullish about the market. In terms of FS and the details, I think I would echo the points that Praveen just shared with you. There are some areas we look at, for example, in the European banks where there's some slowing. We've seen this with capital markets. Typically in Q3, we'll end up seeing overall the seasonality which come from furloughs, but there is nothing sort of materially new in that situation that we see. Having said that, there's a lot of work that we need to do in making sure we execute against all of that, and we remain committed to, and in fact, we're increasing the bottom end of our guidance. So that should give an indication of how we see this year playing out.
Next question is from Mint.
Hi, Ayushman here from the Mint. Can you give a sense of the digital deals, right? What are the size of the digital deals, and also what kind of deals are these? Are these large-scale digital transformation deals, or is it just some automation here and there? I mean, just give me some sense of that.
So the digital portfolio, again, has had a good growth in Q2, 38% overall year on year. It now also comprises just over 38% of our business. So it's looking really robust. A couple of examples. We had a deal, for example, which was focused on what we call user experience, which is really the front end of our digital thinking. There we work with a large confectionery company a global confectionery company, where we've redesigned completely how the experience of their end user is with how they interact, how e-commerce is done through that. And a lot of that design was very personalized, very intuitive. And this is a large platform in which we've built this. Another example is on the cloud, where we worked with one of the large 3 providers for a large US company again, where we built a public cloud transformation program that the client is going on. And here we are partnering with them to bring services which are existing services of the client, plus new services which we are helping them develop, which are more cloud-first services. Many of the deals that we see are large transformation deals, which are modernization deals, in which digital is a strong component of it. So the good news for us is digital is becoming more and more central to many of the new things that we're doing with clients. And we see that the investments that we made, which were last year, are starting to be relevant for how the clients are looking at us from a digital perspective.
Next question is from Hindu Business Line.
Hi, I'm here after about 3.5 years. And one thing that I notably find is that your margins have gone down, operating margins have gone down substantially. Praveen, tell me why this is happening, because you used to be the industry bellwether when it came to margins, and you prided yourself on, profitability over growth. So is it a growth story now more than, margins, or what?
The beginning of last year, when we started the Navigate Your Next journey, we had clearly said that there is a lot of opportunities in the digital space, but that means that we have to invest, we have to build capability and competency. There is a small window for us to capture that. And we also said it's a 3-year journey. We are just 18 months into the journey. And so we have done significant amount of investments. We have done localization. We have invested in living labs. We have increased the sales spend. We have hired people with different capabilities and so on. So multiple level of investments to build the capability to take advantage of this one. And that's reflecting in the kind of growth that we have seen in the last 3-4 quarters. We have said we have given a guidance of 21 to 23%, and that's what we are confident of. We don't want to comment on the future, but at this stage, for the rest of the year, we are comfortable with what we have said. The focus is on investing. I mean, it's not. I mean, obviously, growth is very important, but obviously, we have to have a purposeful growth and a profitable growth. So we are not really diluting the focus on profitability, but we are making sure that we are doing the right level of investment to secure for the future.
Next question is from Business Standard.
Hi, great set of numbers. This is from Business Standard. I want to understand 2-3 things. Firstly, yesterday there was the commentary from the market leader. I don't want to compare it, but there is a sense in the market that the deal conversion, pace of deal conversion is being slowed down due to the macro. I just want to understand that whether Infosys is facing such kind of problem, because TCV is fine, but how much of the deals are actually being converting into revenue is also important. And secondly, I want to understand, are you facing any client specific issues in any of your vertical at this point of time, or will you face such kind of issues in Q3 and Q4?
So on the deal conversion, we've had, as you saw, $2.8 billion in large deals. We've had 11.4% growth in Q2. So we cannot get those sort of outcomes if the deal conversions are not happening well. So for us, deal conversions are happening well. Having said that, I shared a little bit earlier what our view on the macro is, which still holds, but it's not, at least for us, anything with deal conversions. In terms of client-specific issues, we didn't call out anything on Q2. For Q3 and Q4, we'll see as the quarters go. There's nothing today that we'll call out for Q3 and Q4, but we've not called out anything for Q2.
I want to understand how much the cross-currency has actually helped in your margin improvement. And as far as the H1 margin level is concerned, is actually at the lower end of your guidance. So I think our fellow colleague has also asked that whether is 21-23 band within that, will you end up FY20 on the low band of the margin, or can you give such guidance? And my last thing to Praveen sir, last quarter you spoke, I think Infosys for the first time gave some kind of threw some kind of light on the involuntary attrition. What exactly happened in Q2 as far as involuntary attrition is concerned?
So on the cross currency, actually, we've taken a hit this quarter. So while we got about a 30 basis point improvement from the USD INR, but we actually got a hit of about 15 bips on cross currency because the pound and the euro depreciated against the dollar. So whenever that happens, you also see the top line revenue